All right, well, I think we can go ahead and get started. Thank you everyone for joining us this afternoon for the Metalla Royalty and Streaming Corporate Update webinar. For those of you who don't know, my name is Christina Pilon, Investor Relations for Metalla, and I'm pleased to be able to introduce our panel of speakers today, which includes President and CEO Brett Heath, Vice President Corporate Development Drew Clark, Vice President Acquisitions Sunny Sarah, CFO Saurabh Handa, Non-Executive Director E.B. Tucker. So just a few housekeeping items. If you have any questions throughout the presentation, please type them in the question box on your screen and we will try to address as many as possible as time permits during the second half of the session. And as always, if you have any questions following the presentation that we aren't able to answer, don't hesitate to reach out to me directly at info@metallaroyalty.com. With that, I'll hand it over to Brett.
Thanks, Christina, and thank you all for joining us here today for our May 2022 webcast. We do have some great updates. We're gonna be going through a number of the developments within our portfolio. Our corp dev team is going to be sharing that. We also have E.B. Tucker and Saurabh here to, also to answer some questions. But first, we will be making some forward-looking statements here. So please understand those risks, not only on Metalla, but some of our general views. And really, before we get into the updates, we'd like to kind of cover, I think, the number one question that's on investors' minds today, which is, why the weakness in the share price performance recently. We've got people, a number of retail investors up to sophisticated investors, that obviously attack these things a bit different, but they are concerned. We are getting phone calls, and these are really great opportunities here. And what we like to do, just when we're in these types of situations, is understand the long-term trends. And if you catch these trends right, then you don't have to do much, but the market often gives you some just incredible opportunities in the early parts of these trends to position yourself. And on the chart on the left-hand side that you're looking at, this is a comparison chart of the Bloomberg Commodity Index. This measures a broad basket of commodities, and also the QQQ, which is representative of the NASDAQ. And what this does is, I think the most representative kind of index of the general public, right? This is the FANG stocks. This is big tech growth that's been really in this perpetual bubble since 2009, all the way up until recently. And what we're seeing recently is when you get these big perpetual booms in certain sectors, they can create these busts in others. And we've really seen that through capital flows in the commodity markets kind of going in the wrong direction all the way till about 2020 of March, which was kind of the COVID crash that marked the bottom of it. And over the last 2 years, we've seen this divergence. We've seen this divergence move from this big tech growth. I mean, right now we're in the middle of a bit of a crash, which we've got some points to show there. But understanding the shifts in these capital flows, the shifts in these trends and positioning, not only understanding the broader trends, but also the best companies, right? The best companies that are going to thrive over the next 10 years in these big long-term trends. And so if you look at the chart on the right-hand side, which shows just the last couple of years, again, the same one as the left of the commodity index, which measures a broad basket of commodities, to the NASDAQ, you really see that divergence. But the type of chart that we like to watch the most to understand kind of where we are in this transition is really the ratio chart. So when you take these two same indexes, the commodity index and the NASDAQ, and you measure them in relation to each other, which shows the capital flows, you can really see where we are. And this chart is just so powerful for us, right? We see this trend. We talk to some of the largest fund managers around the world. Big tech growth is done, right? Like the trend has changed. The capital flows are shifting. They're going into commodities. The beginning of it was March 2020, really, that marked the bottom of the COVID crash, and we think it's going to last this next decade, perhaps. But we are in the very early stages of it. And when you look at the capital flows on just how extreme it got, from a measure of 5 down to about 0.5, just to get back up to where it was as a relative strength type of comparison, you're talking about a tenfold move, which can be a massive move in just not only the commodity sector, but also the good companies that are involved with it. So, you have to understand that when we're running this business, there's things that we can control and there's things that we can't control. And we can control the business. We can control the health of the business. We control the growth. We control the amount of value that represents per share. We can control by buying really great assets that are continuing to grow, but we cannot control kind of the outside market forces. And when you look at that same NASDAQ chart over the last 20 years, there's been 3 times where there's been crashes. I mean, a lot of times, a lot of people, friends of mine and everything, all they own is Metalla, which is great. They know me, they bought Metalla. It's the only stock that they hold in, and they pull up their Robinhood account, and they don't understand that everything else is moving. They can't see these bigger picture opportunities that can present itself within these longer term trends. But if you look at the NASDAQ, there's been 3 crashes or corrections or whatever you want to call it over the last about 12 years. We had the housing crisis, which took that index down about 46%. We had the COVID panic, which, that thing only lasted really, if you look at the chart, you can barely see it, but that was about a 30% correction. And the one that we're in right now today is also about a 30% correction. And when you get these moves, you get a risk-off scenario and everything gets sold, particularly the smaller cap stocks get really beat up. Now, we've seen this across the board within a number of different asset classes. Not only the junior golds have been smashed as a group recently, but we've also seen, crypto is off significantly, and venture fund is off significantly, and a lot of small cap other sectors are off pretty significantly. There's a lot on sale right now. But as an investor, you want to be able to ask yourself these questions of why is the stock down and what has changed? Now, one great case study that I want to know is a company called Wheaton Precious Metals. This used to be called Silver Wheaton. Now, this is run by Randy Smallwood, one of the smartest guys I've ever met in this business, extremely successful, sharp guy, one of the best royalty and streaming companies that are out there. But if you look at this chart from inception, Wheaton started in about 2004. They were the ones that pioneered the royalty and streaming model and structure. And they came out and they did a number of just great deals, one after another. It took about 2-3 years for the rest of the royalty companies to kind of catch on to what Randy was doing. And he was able to go out and really capitalize on so many incredible assets that really are still the foundation of their portfolio today. But then in 2008, if you're just looking at this chart and you kind of tune out what else is going on, you got an 80% decline. An 80% decline in an incredible company with an incredible management team that went down a lot. And I believe that's right kind of where we are at today. We've done a number of great deals. We started off our business. We were very consistent and growing. We really kind of pioneered a new strategy, which was, creating this platform to buy existing very high quality royalties on proven geological trends, and really, having that platform to consolidate up the best of the best. And here we are at a time where we're in this, I wouldn't say it's even close to as extreme as 2008, but I think we're in the middle of it. Hopefully it's towards the end. And that is the opportunity. Now, did anything change with Silver Wheaton when it went from $19 to about $3? Nothing changed. And in my previous life as a fund manager, this was actually one of the stocks that we went very heavy in between 3 and 5. And it ended up being an incredible opportunity, and rallied, upwards of about 1,600% off that type of pullback. Now, that was also on the back of a big gold push, gold breaking out to new highs. So there were some tailwinds there. But, the business really was consistent from the very beginning when Randy was executing all the way through 2011. But in the middle, you had this massive crash. And so these are the types of things that you want to understand. These are the opportunities that you want to capitalize on. And when you have an opportunity where you can capitalize on a great company with great assets, with great management execution, and you can do it at a great price, this is when you want to buy. Unfortunately, the way the market works is that when everything's down, people are scared, they sell. I can't tell you, this has been this last month, we personally have received more text messages and emails from investors, from friends, novice investors up to sophisticated investors. The difference is how you attack it. When I get a call from a very sophisticated investor, we walk through the business, we walk through the assets, and they've been in the market buying. They've been soaking up, millions of dollars of stock at these levels. And, unfortunately, there's a lot of people that just go out there and they panic because they don't see what else is going on. And that's unfortunately like the typical type of price action for most investors that aren't experienced investors. But we're here and we want to deliver this message. We want to deliver the same message on the opportunity that we believe that is in front of us. And we think it is just probably the best opportunity we've ever seen in the company's history in regards to be able to building a position on a great company at below NAV. It's really an incredible opportunity. And so when you look at Metalla for an example, again, you see very consistent accretive growth. We've been executed consistently since we started this business. We've done it all the way through as the stock has gone up kind of every single year for the first 5 years, very similar to that Wheaton chart. And then also on the way down, we've continued to execute. I would argue that the last 2 years has been by far the most value that we've been able to generate as a management team from the deal side. Yet at the same time, we've seen the most dramatic pullback in the share price, really from the highs, just over 50%, which in my mind is quite wild when you actually look at the business, you look at the value, you look at the execution, you look at the assets, and everything within that is good. And when you look at, just from an analyst consensus perspective, the thick gray line in the middle, that is the business. That is the business that we're executing. It's not a crazy hockey stick. It's not anything that you would see. If we simply buy stuff and that stuff is worth more than what we pay, the NAV per share increases. If we overpay for something and we buy stuff, or we have to take big impairments on things and what we spent is worth less than what we paid, then the NAV per share goes down. Very, very simple. And if you look at what we've been able to execute since the very beginning, it's a very steady stair step higher all the way through. Yet, the chart, if you look at the chart and you look at the NAV per share, these are things that, again, in our control, out of our control, as investors, as shareholders, we want to point these things out. We want to show you where we're at as a business, where the opportunities are, because the markets are going to do what the markets do. Capital flows, again, are really going to be the main drivers. If there's constant capital flows that are going out of GDXJ, where we are, out of the SILJ, these are some of the bigger precious metal ETFs, we're going to feel that, right? We're going to feel that along with the rest of the sector. I would argue in these types of situations, because we have such a strong retail base, you get a little bit more on the upside, you get a little bit more on the downside, just because the way retail investors typically trade between or compared to institutional type investors. So this is where we are today. And again, looking at this business, it's consistent accretive growth. Okay, well, what happened in the last 2 years when the share price has gone from 16 and change Canadian down to 7 Canadian? Okay, well, we've bought a royalty on Côté Gold's or the Cote Gold mine in Gosselin. We've bought Equinox Gold. We picked up a royalty on the Del Carmen project. Oz Minerals, we got a Cortez royalty, a portfolio royalty on the extension of the Fosterville mine, producing royalty on the Wharf mine. These are incredible assets that continue to generate value by the major mining companies that are operating them, pouring hundreds of millions of dollars into them every single year as a group. And as a royalty holder, this is free carried value for you. We do not have to put up a dime. And I know we've talked about why royalties are so great, but this is really the benefit. We do not have a over leveraged business. We've got operating royalties. We're 5 producing, going on to 7. We'll run through that update here shortly. And the business is moving forward. And so in these different situations, these opportunities, these are the times when it's not easy to do, but these are the times when you want to understand what the business is doing and be able to step in and look at those long-term trends and position yourself for the next 5-10 years and really the benefits that will do. It was the same thing for tech in 2009. You could have bought Google, you could have bought Tesla, you could have bought Amazon. Think about where these companies were in 2009. Think about kind of where they were recently. And if you just held those the whole time, what they would do. And that's where I think we are on the commodity side in general. So it's not just Metalla. It's a lot of other companies, the good companies within the relative kind of commodity sector that cover it, whether it's copper or nickel or agricultural or oil. Gold and silver obviously kind of goes to its own drumbeat a bit, but this is again just an incredible opportunity. So with all that, I will pass it off to our corp dev team, Drew Clark and Sunny Sarah, to go through some of the more recent asset updates.
Thanks, Brett. We'll keep it quite short, but what we really wanted to do is highlight a couple of the assets that I think you're going to hear more about going forward or coming on stream. One thing I always want to point out to everyone, we do a very thorough job on our MD&A going through all of the assets. So there's a very comprehensive update on everything that is moving around on our portfolio and then some that we're pretty exhaustive about populating at the end of every quarter. But right now, the first 2 assets I want to talk about are a result of a deal we did 3 years ago with Alamos for $8.6 million. These are just 2 of the 18 assets we picked up from them. And at the time, these were kind of, I wouldn't say throw-ins, but they were smaller parts of the portfolio. The first one is Beaufort. Now, at the beginning of the year, we didn't press release it, although Monarch Mining did. We gave them $1 million US to take out the exemption that was roughly 73,000 ounces. So what that does is bring the cash flow forward and helps them get the mine on track. This is going into production next month. It has 20,000 tons on site and it's ready to go. They've had a lot of success with the drill bit. This is a past producing high grade mine in Val-d'Or. The W zone in particular is one area that they've really had a lot of love, and they're continuing to drill out there. I believe they're doing just under 25,000 meters this year. They're cashed up, ready to go, and that's going to come on in the second half of the year. The other part of our newer assets coming online, which actually is already online, but we won't get cash flow till next year, is El Realito. Now, what's exciting for me and Brett and the rest of the team about El Realito is this is the first asset out of our 9 Agnico Eagle royalties that are going to start cash flowing to us. We view, and many view, Agnico as the #1 gold producer on the planet. This is the first of many of us that are going to start accruing cash flow to Metalla shareholders. So they are pre-stripping this. This is near the La India mine. They're 39% complete, as you can see on the slide, and we're pretty excited to see the cash flow coming in there. Now, this takes our producing royalties from 5 to 7. Next year, we're going to have some more coming online and so forth. We have a lot coming on in the development pipeline, but these are 2 really exciting mines that are coming online, and there's a lot of exploration upside of both of them that I won't get into too much detail. But La India is more or less on its last legs, and El Realito and up to the north of it, La Cipriana, are actually what are now representing the extension of the mine. So Agnico's been quite aggressive in expanding the mine's resource envelope. The last one I really want to talk about, it was one of the first deals that we did when I joined Brett, is the Garrison mine. So Garrison was locked up in a company called, well, at the time it was Cisco Mining, which everyone knows, but we always viewed this asset as something that would be part of a merger and acquisition move that was going to happen in the camp. And our view on this was, and if you look down, if you go look at Moneta Gold's presentation, there's a ton of deposits that were all kind of owned and fractured ownership. They've all been combined today. So what's exciting about that for us is twofold. One, the global resource at this mine is 11.5 million ounces. They have a PEA coming out next month. We don't have an idea of what the production is. We do have past PEA reports that were done by the likes of O3 and Cisco, but it's going to get bigger. One analyst report I read earlier today had 400,000 ounces for over 12 years as a starting point for this mine. It's going to be a big project, and either Moneta goes along or maybe it gets followed up. We don't know, but we're very excited about it. What's great about this, although we don't have a royalty on the entire 11.5 million ounces, this is the starter pit. This is where the mine is going to start. It's got high grade, it's got some past production on it, and it's ready to go. So not only is this thing expanded for us since we bought this 3 years ago, they're now tagging underground intercepts that are going to support mine life extensions. So it's gone to 1.7 million ounces. It's in a growing company. And this mine camp, might I add, is on trend from Timmins, and it's north of Kirkland Lake. Everyone gets to go home at night. These are the kind of mines that get built. We're extremely excited about it. And this is one I think we're going to be talking about quite a bit more as things progress. Next one up is Sunny's going to take over from here.
Thanks, Drew. So mid last year, we acquired a 1.35% NSR on IAMGOLD's large Côté mine that's currently in construction. This royalty covered the northwest portion of the pit, and currently the expected commercial production is end of 2023. So we're hopeful that we'll start getting some production from that portion of the royalty, as you can see in the bottom right, in around 2024. In addition to that, since we had acquired the royalty, IAMGOLD had put a 5 million ounce resource estimate on the Gossan zone. Our royalty covers the whole Gossan zone, and it is directly adjacent to the Côté deposit. They have another 16,000 meters of drilling that they're going to drill to delineate the Gossan zone to expand the resource, and also drill in one zone in between the two pits. They view this as a potential extension to the Côté pit, and there's a lot of near surface ore. One thing I want to highlight over here is that they've only drilled half the depth of Côté, and it's still open at depth, and it's still open along strike. So this Gossan zone can become tremendously big. They've started optimization and baseline data for future permitting efforts, and we'll keep you updated through our MD&A as we hear more on what happens with this deposit. Moving next to the Castle Mountain royalty, we acquired this shortly after the Côté royalty. It's a 5% NSR on the southern portion called South Domes. Since we acquired this royalty, they had submitted a permit to amendment to the state and federal agencies, and things are moving quite well over there. In addition to that, they started drilling in between the Gisla and the South Domes pit to potentially create a large pit or push more optimization into the resources at depth. In addition, they had begun more infill drilling in the South Domes area in the last quarter, so we're starting to see a lot of progress in that area of this the South Domes region. As we move forward, we'll continue to update you on when we hear more from Equinox Gold. Now, this mine is slated to become a 218,000 ounce mine in California. It's currently producing about 30,000 ounces a year. So there's going to be a very large step up in production. And this is currently trucking ore from Equinox's to Equinox's Mesquite heap leach pads, and it continues to get larger as they continue to increase drilling there. Moving to the next slide, we had quite a few really interesting developments from the recent Kirkland Lake Agnico merger. We had this one royalty on the amalgamated Kirkland deposit. This is originally it was originally split between Agnico Eagle and Kirkland Lake, but this merger created new synergies at the Macassa mine, where now they can hit the amalgamated Kirkland deposit and mine it starting in 2024. And they're expecting to do a minimum of 40,000 ounces a year. Now, this deposit is open at depth and along strike. So we're very excited to see that we'll be benefiting from this. In addition to that, at depth, it looks like some of the extensions of the South Mine Complex zone may be going into a royalty land as well. And we'll provide more updates as we hear more. In addition to that, the Canadian Malartic partnership between Yamana and Agnico Eagle had purchased the Camflo property. Now we have a 1% NSR on the Camflo property, and recently they had identified a porphyry-hosted open pitable gold deposit in the area. Now, just some brief history on the Camflo deposit. This mine was owned by the old Barrick Gold, and they had mined 1.6 million ounces from this area. So it's very fertile land. It's by a very large processing plant where the open pit ore from the Canadian Malartic extensions should be decreasing beginning in the later half of this decade. So there is a lot of potential processing capacity if they're able to find something there. We're really excited to see what will happen there, and we'll definitely update our shareholders through our MD&A when we can. Now I'll let Brett discuss a bit more about what we've been up to.
Thanks, Sonny and Gio. And so, yeah, look, we just like to recap. We have kept our heads down since the very beginning, picking up a number of royalties on assets that we had, not only exceptional growth, exceptional potential for resource expansion, significant opportunities in regards to, exploration success, and obviously having the comfort of these very large operators putting significant amounts of capital into areas in these proven geological trends. This is where you want to position your shareholders. This is where we've positioned our shareholders. This is where we've positioned ourselves, because when you look at the real drivers of the share price performance on some of our bigger peers, and if you really break down kind of the driver of the performance of these companies, always came back to these either big discoveries or resource expansion or resource growth. It was never the billion-dollar deals that they did at one time's NAV to provide all of this cash flow, right? These are swapping dollar type transactions. They're very, very, very competitive. But the $2, $3, $4, $5 million investments that ended up being worth $100 million or $200 million or more is really what drove that performance and allowed a lot of these companies to really leverage these assets and build to become the multi-billion-dollar majors as they are today. And so that has always been a focus. It's always been a focus when we buy any of these royalties to have these types of characteristics. And if you look at our portfolio, we've got 70 royalties. I mean, it's crazy to think about. We started from scratch, right? About a little less than 6 years ago, we had an idea, and we went out. Very, very few people understood it. We went out and we executed, and we kept our heads down, like I said, and executed. We built out this portfolio. The whole portfolio 5 years later is now at this inflection point. And if you look at what we have producing, these are all great assets. But when you look at kind of what's coming online, I mean, any one of these royalties, not any one, but a lot of these royalties that are coming online by themselves are going to equal almost or even more than our total production that we have from the first 5 potentially 7 coming online right now. These are big, solid, long life assets that are key in these major mining companies' portfolios. If you look at Castle Mountain, I mean, this is going to be pretty much one of their flagship assets as they develop phase 2. Fosterville, obviously, everybody is very well aware. I mean, that's I would say, the best asset in even the merged Agnico Kirkland pro forma company. Tocantinzinho, G Mining has done an exceptional job on that. We've got 2 million ounces there. That's likely going to be probably around a 200,000 ounce producer. Santa Gertrudis continues to grow. We've seen our resource expansion on that royalty since we bought it go almost 300%. So I mean, this is significant growth that we've seen. These assets are moving in production. When you look at the development side of the business, typically it's highly discounted because it's so difficult to build a mine these days, right? It's so hard to build a mine. There's so much risk in all these development assets that are around the world. There's financing risks, there's geopolitical risks, there's all these different risks. It's becoming more and more difficult to build these mines. And so as we've selected these royalties, there's very, very little risk in our view that these things don't get built. And maybe they're 6 months delayed or so forth. I mean, that's typical for any mine. But these companies, they need to replace the ounces that they're mining. And these assets that we have royalties on, not only are they growing, but they make up a meaningful part of those ounce replacements that need to be mined. And so there's very, very low risk that these things move forward. Yet at the same time, the opportunity to buy these things at such a significant discount to where you're trading today, is truly kind of an exceptional opportunity. But I believe we are at this inflection point. We are going to have continued growth, new assets coming online, much bigger assets coming online, longer life assets coming online every single year for the next decade. I mean, that's pretty incredible when you think about it. I mean, almost every single year, if not every single year for the next decade, we expect a different significant royalty coming online that we've already paid for, that's free carried for these shareholders. And that's growth. That's real solid growth at a time where the sector is starving for it. I mean, if you look around the business and you look at what's going on, it's literally starved of growth, and you're seeing companies start to eat each other and everything else. And we've got really kind of the most valuable part sitting within Metalla today. So with that, I guess we can open it up for some Q&A, and I'll also pass it over to EB if you've got any further comments.
I want to say something quickly. Can you hear me?
Yeah.
We're good. Okay. So I want to say something to everyone separate from what we've been talking about, because this is a nice forum. Everyone here is a shareholder. This is a time when we can be a little bit more personal. It's not a TV appearance or something like that. And you're here today to figure out what's going on with your company. And you need to understand that I also share the same sentiment, and I'm very involved with the business. And I want to tell you something that happened to me recently that might help you understand how I look at things. Because some of these people that have called me in the last few weeks in a sheer panic have been stunned that I'm not that panicked. And they say, well, you must have lost millions of dollars. And I say, well, so what? I mean, because I'm not on a roulette wheel. Okay. This is a business. If I had a business that plumbing company or something, I wouldn't have the business valued 10 times a day and make panic decisions every time the valuation changed. I wouldn't do that. I would build the business because I wanted to build the business. So I want to share something that's happening. Long time ago, I met this guy who sells silver coins on television. And you might have seen this guy. I'm not going to mention his name, but he's very successful. He's very rich. And when people ask him, what do you do for work? He'd say, I turn quarters into dollars. That was his slogan. And so he's done that. He's done it very well. And when I got to know him and learned about his business, and then went down my own career path, I met a guy named Doug Casey. And Doug Casey told me that what he does is he turns dimes into dollars. So I thought, well, this is, this is getting better and better. I mean, the more I learn, the more I like it. And so eventually you try to turn pennies into dollars. So that's real alchemy. That's our long-term goal. Okay, so I made a career out of trying to turn dimes into dollars. And one thing that I did is I bought all this rental housing in 2010, not 2009. Everyone thinks it was 2010. And I paid next to nothing. And the last 2 months, I've been selling a lot of this rental housing. And so I want to tell you what's been happening is I go to the closing and I'm getting these checks. They're quite large. I mean, like $250,000 average each. And I'm telling you, you get a $250,000 check every 2 or 3 weeks for a few months, and you really start getting used to it. It's quite nice. But the people at the title agency are somewhat, I don't want to say disrespectful, but they make some snide comments to me, like about, well, this must be nice or something. And I say, well, let me just tell you something. When I bought this house, I paid $10 per square foot for this house, okay? And everybody told me I was an idiot. They said, it's going to turn into a war zone. The real estate market just crashed. Don't you know what you're doing? There's plywood on the windows. The roof is caving in. What's wrong with you? Okay. And I said, I think it's a good time to buy a bunch of real estate, pay cash for it, because it doesn't seem like there's a lot of downside. Now, fast forward 11 and a half years or so later, and I'm walking out of the title agency, same title agency that told me that something was wrong with me. I'm walking out of there with a check for $250,000 and coming back 2 weeks later, get another one and another one, another one, because it's just magic. So I just want you to understand that if you want to turn a dime into a dollar, you can't be afraid of what people think about you, because you're almost always going to be doing something that to everybody else doesn't make any sense. It doesn't make any sense. And so why would you want to own a gold royalty now? Okay, well, I'll tell you, because they have no employees. So Drew and Sonny and Sarab and Christina and Brett is only, I don't work for the company. They're the employees, okay? So you have no employees. Well, what's the biggest thing facing people now? Cost of employees is rising. Great, we don't have any. Okay, so what about fiscal, the budget? You know, that's everybody's worried about, you know, spending, we're going to recession, all this stuff. Okay, well, great, because this business floats with costs as they rise. So as the costs rise to dig the hole in the ground and pull out the gold, we don't pay any money. So you start looking at this business and you say to yourself, okay, well, if I was going to go away for a year and disappear, what would I want to, and I had to own one stock, what would I own? I would want to own a royalty stock. You could pick whatever royalty stock you want. If you don't like this royalty stock, try another one. But I encourage you to investigate and say, where do I want my money? What business do I want to own? Because that's what's important. The stock was $13.50 US. Everybody was enamored with it. The company's done about a dozen acquisitions since that time, and the stock's half the price. In my opinion, I'm seeing plywood on the windows and I'm ready to buy. So I just would encourage you day to day right now to realize the NASDAQ's going to fall lower. The interest rates are going to go higher. The crypto people jump out of windows. I mean, it's going to be bad. And you have to ask yourself, what do I want to own? Okay. And when you ask yourself that, I'm not advocating on my stock, but I'm just saying you really have to think past what's happening on your smartphone. When you look at the screen, Robinhood or wherever you have the stock, you really have to ask yourself, what do I want to own if this gets worse? And the answer might be nothing. It might be cash, but if you got to own something, that's the way to look at this. And that's how I'm looking at this. And I hope that might help some people understand kind of perspective is the name of the game. If you're in the money business for the long term, you really have to have a strategy. You cannot be trying to change your mind 10 times a day. You drive yourself crazy.
Thanks, Evie. So we'll go to some Q&A. If anyone has any questions about anything about the company, about what we discussed today, feel free to type them in the question box. We'll try to get to as many as we can here. So we're seeing some questions on inflation, really the impact, and inflation has been impacting the mining sector dramatically. And one of the things I want to point to the most of really kind of showing the immediate impacts are really the cost overruns on the new builds. If you look at all the different mining companies right now that are in the middle of building a new mine, they are expanding their estimates on CapEx by like 100%. Like, it's not like it's 20%, it's not 8% or 7% where the Fed says it is, but it's like literally 100% increases, you know, if you go back and look at their estimates a year over year. Now, as a royalty holder, you know, if you look at, as an example, you know, one of our best assets, and I think will potentially be our cornerstone asset with Cote Lake. I mean, IAMGOLD is just, I mean, it's just crazy to see these increases in CapEx. But the mine's 50% built. It's already today just about 20 million ounces. It's gonna get built. Now, are those costs gonna affect us? No, because that is our royalty is a free carried, non-dilutive, perpetual interest that results in top line cash flow. So all of the inflation that the mines are experiencing, which is eating into their margins, doesn't affect the royalties. The royalties are an inflation protected asset. And when you're in that type of environment, that's why these things are so incredible, because they're not only inflation protected, but they're also connected directly to, you know, what I think is one of the most important monetary or commodity assets that are related to kind of the monetary flows of any other sector. So that is why you want to own mining companies, or sorry, royalty companies, and not mining companies. Just continuing on here, we've got some questions about the dividend. So what we've always said from the very beginning is that, you know, we will take 50% of the operating cash flow. So obviously we need the cash flow to run the business. It costs a lot of money to have a US listed company. You know, we're seeing inflation. I mean, it's nothing like the mining companies with their cost rises and everything, but you know, the accountants and the lawyers, the exchanges, the insurance, all these things are going up. Everything's going up. Just like when you go to the gas station and fill up your car, or you go to the grocery store, it's costing you more money. It's costing more money. And so, you know, from an operating cash flow perspective, in the early days, we had most of our cash flow coming from one asset called Endeavor. You know, Endeavor may come back on. We think that there's some good opportunities there in the future, but that went on care and maintenance. And so we had to backfill that, and we've done a very great job at that over the last few years. We brought on some new cash flowing assets with Wharf, with Higginsville. We've got 2 more that are coming on. And so right now we're just really positioning the company right now to get back to that operating cash flow positive. We've been operating cash flow positive, very close to it, within the last couple of quarters. And I think with these new 2 royalties coming on, it's really going to position the company where we can turn that dividend back on. So that is a goal for us, and definitely in the future with the dozens of assets that are going to be coming on, that dividend will continue to be a kind of an important part of it. But you know, again, it was always kind of measured off an operating cash flow perspective. Stock buybacks, you know, we haven't really thought about stock buybacks before. Now, you know, in certain times like we are right now, obviously it would be great to buy stock back. And, you know, if the market misprices the stock for long periods of time, then that's something we'll definitely consider as we move forward. We've got some questions on share dilution. So, and we get this question a lot, and it's often, you know, something that is a little bit complex for investors to understand. So we are, in our business, is a growth by acquisition type company. So everything that we buy, we have to raise capital for. We've done this since the very beginning. You know, we didn't go out and raise a pile of money and then go out and try to put it to work. What we've done is we've basically raised the capital as we've put it to work, as we've continued to grow the business all the way through. And again, this goes back to that chart that I showed earlier in the presentation, which is the NAV per share. If we buy something and it's worth more than what we buy in the public markets, then that's accretive. That generates value for shareholders. That generates value. It makes the share price go up on the NAV per share. The value of the share goes up on what we own. If we pay for something that's worth less, that's going to decrease the NAV per share. And so every time we have to issue shares to raise capital to buy assets, whether it's through the ATM, whether it's through the BD facility, whether it's through private placement or another structure, you know, what we're looking at is okay, if we buy this asset, you know, is it worth more than when we bought it? And will that generate a NAV per share growth in the business? And this is what we've been able to execute on successfully 28 times, according to 5 analysts consensus estimates on all of these different acquisitions. Continuing on here with some more questions, we'll answer a couple more here and then we'll wrap it up because we're coming up on an hour here. So let's see here. Yeah, so we got a question on, you know, how is the environment for acquisitions with this big pullback in precious metals? You know, what we're seeing at least on the gold side of the business is it is becoming more selective on very good assets. So there still is a number of opportunities with, you know, call it kind of lower quality type situations, maybe junior producers. You know, there's interesting exploration stuff, but the good high quality stuff, you know, we're seeing that particularly on the origination side with the big companies. I mean, the origination side, providing capital to mining companies to finance and build mines, that is a very difficult part right now because the big mining companies, the big base metal mining companies, these companies are not entertaining a lot of opportunities on streams. Junior single asset producers, they're still in the market for streams and royalties on origination. Our business of buying existing royalties, you know, it's a little bit different. We aren't exposed to kind of the ebbs and flows of the stock market when it comes to the performance and the strength of the mining companies. So we're still able to you know, execute. You know, right now we're in a position where you know, the market is changing, right? The market is changing. We're seeing lots of M&A. We continue to see lots of conversations, you know, around the sector, around M&A, and you know, I think it's healthy for the sector. So we've positioned our business to be the most flexible at this time, to be able to take advantage of any opportunity that shows up. And you know, we're looking at all this stuff. So these are things that that we're contemplating and that we're evaluating day to day. Okay, so I think that will pretty much wrap it up here with the questions. If you do have any questions or your questions weren't answered, please go ahead and send them in to Christina, but I'll hand it back to Christina to close it all off.
Sure. Thanks, Brett. Thanks everyone on the panel. That concludes the webinar today. Again, if you have any questions, don't hesitate to reach out to us by phone or by email directly. And this webinar was recorded, so it will be available on our website, on Twitter, and on LinkedIn following the conclusion of the presentation today. Thanks, everyone.